When a government decides to build a massive infrastructure project or a corporation plans a global expansion, the price tag often runs into the billions. That kind of capital requirement immediately outstrips what any single traditional commercial bank can safely lend. Instead of asking a bank for a loan, these massive sovereign entities and global corporations bypass the middleman entirely. They appeal directly to the public markets to raise the cash. They do this by issuing a bond. A bond is a tradable debt security. By purchasing one, the investor legally takes on the role of the bank, providing capital in exchange for a scheduled series of payouts. There is a functional distinction here that defines how this market operates. While a mortgage typically remains a static entry in a bank ledger, a bond is a tradable security. From the moment of issuance, its value is subject to constant negotiation on the open market. This liquidity means that bond prices are constantly reevaluating the borrower's promises against the current state of the global economy. This creates a system where debt isn't a locked contract, but a fluctuating indicator of value. Every bond starts with a strict legal blueprint. Take a specific example, like the 2% U.S. Treasury bond maturing in 2041. This contract is built on three core pillars. The first is the nominal value, also called the principal or face value. This is the exact dollar amount the issuer borrows, and it is the exact amount they owe the bondholder at the very end of the contract. The second pillar is the coupon. This is the predetermined fixed rate of interest paid out to the lender. For our Treasury bond, that's a 2% annual payout, usually split into 2 equal payments every year. The third pillar is the redemption date, or maturity. This is the exact date in the future, in this case, the year 2041, when the contract expires and the issuer must repay that nominal value in full. While governments usually stick to this conventional fixed-rate structure, corporations will tweak the blueprint to attract capital. They might issue medium-term notes for shorter borrowing periods or floating-rate notes, where the coupon adjusts periodically based on benchmark interest rates. Yet, regardless of the specific terms, this legal structure only dictates mathematical promises. The safety of those payouts relies entirely on whether the issuer actually survives long enough to pay them. That brings us to default risk. This is the probability that the borrower, be it a company or a country, will miss an interest payment or fail to return the principal. To quantify this, the market relies on independent credit rating agencies. This table displays how agencies like Moody's, Standard & Poor's, and Fitch evaluate default risk. At the top, you find the investment grade category. These are the highest quality issuers, boasting ratings from AAA down to BBB. Looking further down the table, we enter the non-investment grade section, also known as junk bonds. These belong to financially weaker companies with higher debt or lower cash reserves. To convince anyone to lend them money, they're forced to offer much higher yields. To mitigate this risk, corporate issuers sometimes offer security provisions. They might pledge a fixed charge over specific physical property or a floating charge over their inventory, giving bondholders priority access to those assets in the event of liquidation. In the bond market, risk and reward operate in lockstep. The system calculates the precise price of trust, demanding the highest payouts where trust is at its lowest. Once a bond is issued, it enters the secondary market. Long before their redemption dates arrive, these debt contracts are aggressively traded among institutional investors, pension funds, and banks. This introduces market risk. The fixed coupon of an existing bond doesn't exist in a vacuum. It constantly competes against the new, ever-changing interest rates set by central banks. Think of it like a seesaw. If general interest rates rise, an older bond's fixed coupon loses appeal, so its price must drop to compete. Conversely, if rates drop, that older bond becomes highly valuable, causing its market price to surge upward. This sensitivity to interest rate swings is known as duration. Longer-dated bonds carry higher duration risk because the investor's capital is committed to that fixed coupon over a longer period of economic uncertainty. A bond's market value is never static. It is forced to constantly reprice itself, ensuring its fixed promises mathematically align with the reality of a changing economic landscape. Because the market price fluctuates so wildly from the original nominal value, checking the printed coupon rate gives you a misleading picture of your actual return. To find true return, first calculate the flat yield. annual coupon payout divided by current market price. But the ultimate metric is the gross redemption yield, factoring in flat yield plus the guaranteed capital gain or loss realized at maturity. While bonds typically lack the extreme volatility of equities, they are not immune to danger. Investors face risks: inflation eroding returns, market liquidity completely drying up, and the borrower's potential default. Bonds are active mathematical instruments. By looking at yields and credit ratings, we can see how the market puts a precise price on time, human trust, and the expected path of the global economy.